the Canadian Financial Summit Expert Question and Answer Session. I'm here today with Andrew Dobson and Jason Heath of Objective Financial Partners, and we're answering all questions to do with high net worth investing in Canada, obviously. And I guess we have the ability to answer if you're leaving Canada too, now that I think about it, because of course, Objective works with expats as well. So thank you, gentlemen, for joining us and answering our audience's questions today.
Thanks for having us.
Welcome. Thank you.
Just to let the viewers know, this is my first time sort of navigating this platform and doing the live thing. I'm super used to clicking my Zoom link and hitting record. So if I screw up, it's not Jason and Andrew's fault. I take full responsibility. So yeah, before we sort of get in and just into it, just letting folks kind of trickle in and get the hang of commenting on the YouTube stream, because that's where you're going to have to ask your questions, guys, if you want them answered, is in the YouTube question comment, and then they'll pop up here and we'll answer them. I just thought I'd ask Andrew, what does it mean to be a high net worth investor, and what does the planning look like that's unique for high net worth folks specifically?
Okay. Yeah. Well, high net worth investing, I think that when you're looking at what, like, I guess a standard sort of, I guess, Canadian would invest in, there's like typical vehicles that you would talk about, like TFSAs, RRSPs, RESPs, and the like. I think when you kind of shift to like more high net worth investors, you end up focusing on different types of structures, because the reality is that once you kind of max out several of the, I guess, typical registered plans that are available for Canadians, you end up having to find other ways to invest your money. And honestly, a lot of it has to do with taxation and trying to figure out ways to minimize that. And I think that there are not only like investment vehicles, but like legal structures that allow often high net worth individuals to maybe access more efficient investing, because it's materially important for them to look at that, because they're going to be affected in a much bigger way, because they're no longer going to have access to things like RSP deductions or tax-free investing through TFSAs. So I think the dynamic does change once you get to a certain high net worth level, and especially if you have lots of money outside of, again, registered plans and like your primary residence. So I think I'd probably say that it just kind of opens up a can of worms in a sense when you start talking about a certain level of wealth.
Yeah, there's more room to sort of optimize. There's more variables. Would you say that's kind of that's kind of the ballpark you end up playing in, Andrew?
Yeah, I think there's more, and like there's more sensitivity to small decisions too, right? Because we're talking about a bigger scale, right? So like a 1% change in net worth on someone that maybe has $500,000 investing is different than someone who has $5 million, and that change in net worth can drastically affect many decisions, more so when we're talking about scale. So I think that would probably be one way to look at it.
Yeah, and I find too, a lot of folks with high net worth, they're focused. The idea is, well, we know we have to pay a lot of tax, so they allow their investment decisions to kind of be dictated by that. And of course, we'll get into that in a little more depth and what sort of order you guys look at and how the financial planning process sort of works. For those of you that are just tuning in, we started a few minutes ago. I'm here with Jason and Andrew from Objective Financial Partners. If you have questions on high net worth investing, please try to keep them succinct and brief, and chat in the YouTube comment section, and I'll pop those up here on the screen. So the first one we got here, Andrew and Jason, is from Corinne, and we'll just pop that up here. Do you think new retirees should hold bond ETFs or use other fixed income products? If so, what do you recommend? And maybe I'll add to that, guys, if you could just give me a brief overview of what the heck a fixed income product actually is.
It's a good question. So, and timely. I mean, 2022 was a brutal year for bond ETFs in particular. So fixed income products, I mean, I think most people are familiar with savings accounts and GICs and sort of typical fixed income, but you can invest in bond exchange traded funds, bond mutual funds, or sort of pooled products like that, where you hold a whole bunch of bonds through a single product. 2022 was a pretty brutal year. I think the sort of broader Canadian bond market, the universe was down like 10% in 2022. And then there were a lot of people, conservative investors, who I don't think understood that they could lose money in bonds. So again, timely question for retirees and someone who's drawing down on their investments, who typically think about bond ETFs about being safe. You have to look at the kind of bond ETF. Short-term bond ETFs are not as volatile as long-term bond ETFs. So a long-term bond ETF when interest rates move in the other direction, you can have a bad outcome. So if somebody had a long-term bond ETF in 2022 and interest rates went up, there's an inverse relationship with bond prices and interest rates. Interest rates go up, bond prices go down. So lots of people have got burned big time on long-term bond ETFs. So I think it's important to understand the type of product you're buying. And these days, when you can buy a 6% plus GIC in Canada with no fees, with no complexity, I mean, I think there's a good case to be made these days for GICs, for conservative retirees or just conservative investors generally.
Yeah, do you sort of follow the same track, same sort of pros and cons there, Andrew?
I think that when you're looking at bond ETFs as part of your overall portfolio, you have to understand why you're investing them. And I think that's one of the biggest problems that we've seen in recent years is that people have, like, going up until 2022, people have looked at bond returns to that point, and let's say 10-year average in the low single digits. So a lot of people question why that is there. And then add to that the fact that in 2022, they were down double digits. A lot of people look at that and say, why would I even have this in my portfolio? I think the point is overall is that given that there are years like 2022, which are an anomaly and that only happen, every several decades, we have to consider that for a very, very long time, bonds have served their purpose in portfolios, right? Think about the financial crisis as a good example. If you held any allocation to bonds during that point in time, rather than have a negative 30 or 40% return in 2008, you'd have seen something closer to like a 20% negative or even 15 if you had some sort of allocation to bonds. Because ideally what happens is if the stock market goes down, your bonds are going to go up in value, because usually when there's a stock market, essentially a bear market or even a minor correction, you might see monetary policy change, meaning rates will get cut, meaning those existing bonds that you hold will likely go up in value. So I think that taking 2022 aside, I think they have a place, but you have to be comfortable with the risk. They are not risk-free investments. Okay, they do fluctuate with the market. So they're different than GICs in that regard. And let's remember, GICs are paying well now, but they didn't pay much prior to the last few years. And bonds may have had a similar return profile during that period of time. So what I'd say is that understand why it's there. Is it there to provide income, or is it there to provide a placeholder, a backstop to the market going down? And then that can help you really contextualize how you want to invest in it, and then maybe how much exposure you want to duration, which is essentially the risk that you're taking with those bonds. So as Jason mentioned, long bonds are going to be more sensitive to interest rate changes, whereas shorter term bonds are not going to see as much fluctuation. So there's a whole sort of menu of bond options or fixed income that you can buy. So you just have to really understand why you have it in your portfolio.
Got you. We're going to switch gears a little bit here, and we're going to go to Aditi. And he says, can you dissolve a TFSA or RSP if you want to leave the country? And I'm going to tie in, I got a second question from offline that was kind of in this same neighborhood as far as high net worth, maybe looking to become a Canadian expat. The person had a similar quandary. They were looking at constructing a portfolio. They had $2 million, and they were saying, are there certain asset classes, or is there a way to structure this thing that I can use to lessen the burden of the exit tax? Are there any high net worth strategies for avoiding that? So how does that work, guys? You go to leave Canada, you're going to become a resident of another country. Is there sort of some rules of thumb or sort of best practices that you direct people to?
Well, I think one consideration with the TFSA, pretty much any other country that you're going to go to in the world will not recognize a TFSA. They don't know what TFSAs are. So if you're going to a country that taxes the residents of that country on their worldwide income, your Canadian TFSA may not actually stay tax-free. The income might be taxable in that other country. So there may be some instances where, again, if you're taxable on your worldwide assets regardless, where you decide to close and dissolve your TFSA, there's no reason you couldn't do that. I like keeping a TFSA in place in some circumstances, because if somebody is going to return to Canada someday, if they leave their TFSA, they leave it invested, it continues to grow. Instead of having a $50,000 or $100,000 TFSA, they may have a $200,000, $300,000, $400,000 TFSA when they come back to Canada, and the TFSA is, again, a tax-free opportunity for them. So TFSAs, again, I think it's a matter of understanding the pros and cons. RSPs, the thing with an RSP account is there's withholding tax when you take a withdrawal from your RSP. And most countries in the world, if you leave Canada, the Canada Revenue Agency or the financial institution rather that holds the RSP is going to require withholding tax on a withdrawal. Typically, it's going to be 25%. So to pay a lump sum tax of 25% to cash in your RSP to bring it somewhere else in the world, there may be an advantage if you're going to somewhere where there's no tax. You're going to the Middle East, you're going to a country where there's a very low tax rate. But in a lot of cases, frankly, we see expats who keep their RSPs in place. They may return to Canada someday, and even if they don't, they might just draw them down slowly over retirement. And often those RSPs, unlike TFSAs, continue to be tax deferred, even if someone's in a country that taxes worldwide income. So,
Andrew, what do you think about the idea of, okay, I got $2 million, I need to invest it right now, sometime in the next 3 to 5 years, I'm leaving the country. Is there anything I can do with that? Or how would you kind of layer this in the decision-making ladder in terms of, okay, someone comes to you with $2 million to invest, they may or may not leave the country. Any way they can structure that portfolio to avoid the exit tax? And I know I'm using exit tax as the non-legal term. I'm not aware of any, but I'm not the high net worth specialist.
Yeah, well, I guess I'd say that I'm not like an exit tax specialist myself, and I think Jason has done much more work in that area. So I would say that, you got to line up anything that you're doing with your goals, regardless of tax. So I'd say that you have to be cautious in that area too. But maybe Jason has some points.
Yeah, no, I was going to say, with a non-registered portfolio, unlike a TFSA and an RSP, if you do leave the country, there's generally a deemed disposition. It's as if you sold all of the investments on the date that you leave. So if you have a $2 million portfolio that turns into $2.5 million, for example, there's a $500,000 deferred capital gain. When you leave and give up residency, it's as if you've triggered that $500,000 capital gain, as if you sold those investments. Is there a way to avoid it? Would you invest differently? You could put the money in GICs and not earn a capital gain. I'd say I'd rather invest based on investment risk tolerance and take the appropriate approach, right? There may be, this is getting sort of technical, but there may be opportunities to defer the capital gains tax by providing security to the Canada Revenue Agency. But that, I find a lot of people in practice just say, forget it. Like, if I'm breaking ties with Canada, I'm breaking ties with Canada. And yeah, so.
Yeah, that makes sense.
Yeah, and often people will be moving to a jurisdiction with lower tax anyway, so they're okay with like paying that upfront cost to moving because they know that on an ongoing basis they might go to jurisdiction with no capital gains tax, etc. So
right.
I think that to put Jason's point, you want to align it with your goals, I think, in most cases, and not let tax wag the dog.
Yeah, I was just going to use that exact metaphor, Andrew, letting the tax dog wag the investing tail, or however that would go.
Yeah, whatever the term is.
Yeah. Okay, just quickly, if you just joined us, I've got Jason and Andrew here from Objective Financial Partners. We're answering questions live, so please feel free to toss your questions in the YouTube comment question feed, and I'll do my best to get to everyone here. We got Erwin now. Erwin asked, do you think there's a place for proven trend-following techniques as a component of a seven-figure investment portfolio as a way of smoothing out your overall risk profile? That's a really cool technical way of asking about like stock picking or like asset class picking, I guess. But I don't know if any. Maybe you guys can enlighten me.
It's tough. I
know, is indexing a trend or something?
Yeah. If that index is index, or if that trend is index investing, then yes.
Smooth. Yeah. Well, smoothing usually refers to like, I think, risk management. So I guess it kind of comes down to portfolio theory and like looking at your risk tolerance goals and time horizon. And like smoothing can be accomplished through, sometimes currency hedging or like, again, holding fixed income in your portfolio, having a cash buffer. There's different ways to do it. But I guess trend, I think that's sort of like, what is that term? What are we referring to there, right? Are we talking about following certain like momentum trades or things like that? I'm not sure. But if you're looking for a general trend, I think keeping your investing costs low is like one way to do it. But then like diversifying is also another way to make sure you don't get caught in a specific market when maybe you're like in an historically bad period. So I think that, I guess it's a loaded question. I'm not sure how to answer it specifically, but I guess those are a few points. Is just follow portfolio management 101, and I think that you'll find a way to make it work. But diversification often helps smoothing, and proper risk management helps smoothing as well, rather than go all in on one specific investment.
Yeah.
I think, Erwin, I'll let Jason comment, but my thought is, if you have been marketed or sold a product that purports to follow trends in order to gain market edges, I would really seriously do some research on that, and you can't do enough research and then send it to me, because I haven't seen any research that dictates that a trend following of any kind would lead to outsized market results. But maybe Jason has. Jason, have you heard of any of these strategies?
Look, I think one of the challenges with trends is you need to be on the right side of the trend, and it's very difficult. It's almost like market timing and trying to pick the right time to move in and out of the markets. Very difficult to do, and there's academic research that shows that. So I think that any trend following should probably be rather modest. Sometimes people will use different managers for different parts of their investments, particularly high net worth investor. Is there a place for a specialty manager that's going to make big bets and try to provide some diversification within the portfolio? Maybe. I think over the long run, though, it's tough, because that ends up being expensive, adding to fees. And again, it's hard to be right more than 50% of the time on trend following or market timing. And so I think diversification is probably and low fees are probably the best things you can do. Investor psychology, staying invested and being in an appropriate portfolio for your risk tolerance, as opposed to trend following. But the one thing that I will say is, even if I or we have our own investment biases, we really try to take an approach with investors to help them understand the pros and cons of various things. And, not everyone's going to invest their money the same way. So.
Okay. That is basically what I expected to hear from you guys, given what your presentations at the summit and in the past. We've got Michelle chiming in here with a subject near and dear to my heart, with many U.S. relatives and Canada-U.S. connections. What are the tax implications for a Canadian resident? I guess this isn't really a high net worth question, but let's see if we can help Michelle out. What are the tax implications for a Canadian resident with a small company pension in the U.S.? I assume that means coming from the U.S. Would we have to file U.S. taxes? Thanks.
Good question. So generally speaking, if somebody is a U.S. citizen, that's an important consideration. If somebody is a U.S. citizen, which you don't need to necessarily be to have worked in the U.S., a U.S. citizen has to file a U.S. tax return every year, whether they like it or not. If a Canadian has lived and worked in the U.S. and has contributed to a U.S. pension, generally speaking, their final obligation to the IRS is withholding tax that's withheld on the pension withdrawals. They report it on their Canadian tax return. They get to claim a foreign tax credit, so there's no double taxation. But oftentimes there can be opportunities to transfer foreign pensions, including U.S. pensions, into your Canadian RSP. That gets really tricky, especially with the U.S., to make sure there's no sort of tax leakage. But look, it's not uncommon for people to end up with these foreign pensions in other countries. The main thing is, certainly for Canadian taxes, we pay tax on our worldwide income regardless.
Yeah, I know that's the case with my relatives, Jason, is they do have to file taxes in the USA and in Canada, but they don't necessarily have any tax owing due to the various, like you say, treaties and credits back and forth. But I don't know, did you have anything to add on that, Andrew, as far as company pensions coming from the States?
I'd say like just keep in mind, like look at what type of pension you have and try to understand when you'll be able to access it. There's different rules depending on the type of account, like if it's a Roth IRA or 401k or whatnot. Uh, and then if you're going to incorporate that into your plan, just understand if it's material or not too. I think that sometimes people get hung up on not dollar amounts, but what the actual thing is. But sometimes it's not material. Like I've had clients that have like a small like 401k or IRA, and they literally just like withdraw the whole thing in 1 year, and then that's it. It's off their plate.
Sure.
So you got to look at the sort of scale to really consider if it's material to your overall plan.
Yeah, that's a great point.
That
If you could withdraw in 1 year and stay within the same sort of tax range, and then not have to file taxes every year, that would be a win.
Well, sometimes that's the case, right? If someone only works there for a couple of years and they've only accumulated maybe 40,000 of pension, why have that as like an ongoing sort of consideration? If you're going to need 1 year's worth of income in your first year of retirement, that could be one way to get it.
Absolutely.
But anyway, yeah.
Okay, let's switch it up again here and go to Scott. How can you minimize taxes while removing Canadian stock dividends from a corporate holding company account? I think Scott has hit. I had several comments after the summit ended, and I might ask an objective financial partner to come on next year for a whole session on just what investments to put in a HOCO account, because I think that's ultimately what Scott's getting at here. But to answer his question directly, sort of how do you guys approach Canadian stock dividends that are held within a holding company and getting those from the corporate ledger to the personal finance side of things?
Yeah. Well, I guess to try to explain this as simply as possible, a corporation, when you have a corporation, you've got a business that you've set up, and you're earning a profit and you're investing the money in stocks and bonds and ETFs in that business, or sometimes you might have a separate holding company that you're shifting profits over to solely to invest. When the corporation earns investment income, it pays tax too. A corporation's a taxpayer. It pays a high rate of tax on the investment income that it earns. But a portion of the tax that a corporation pays, whether it's Canadian dividends, foreign dividends, interest, capital gains, whatever, a portion of the tax that it pays is refundable tax. And that refundable tax can only be refunded to the corporation when the corporation turns around and pays a taxable dividend to the shareholder. So one way that you can minimize tax on corporate investment income is to pay dividends out to yourself as a shareholder. You're going to pay tax receiving that dividend, but especially if somebody's in a low tax bracket or a modest tax bracket, they may pay less personal tax receiving a dividend from the corporation in their hands personally than the corporation's getting refunded back to it. So you might pay a small rate of tax on taking the dividend out. The corporation gets a bigger tax refund, and overall it can be beneficial. So oftentimes when a corporation has a lot of investment income, there's a benefit to paying out dividends every year, particularly if you're in a low or moderate tax bracket.
Yeah, and anything to add on top of that, Andrew, as far as clients you've worked with and sort of the different scenarios that you've seen when it comes to, taking money out in the most tax efficient way, or whether they should even keep their investments on the corporate side of the ledger?
Well, I guess like one of the challenges for business owners is in some cases it's not feasible to like collapse the holdco because there's maybe too much in there, and to draw everything out in 1 year, unless you're doing some sort of advanced tax strategy, it could be costly to essentially like wind up a business. So the concept that Jason's referring to is to essentially try to move money out of the corporation by, if you're able to, paying out eligible dividends, getting the tax refund in the corporation, which in a sense like will add capital. So it's like sort of a relationship where you're taking money out but adding money back in the sense that there's less tax being paid on those investments. But you just have to look at sort of what your cash flow needs are personally, what other sources of income you have. So it is a bit of a calculation in terms of doing like both sides of the, I guess, maybe not ledger, but looking at both assets and how they interact together. So this is a complex topic. We deal with a lot of clients that want to look at this because, to be frank, even accountants that are preparing corporate tax returns might not really be looking at the efficiency of what to pay out. They're just filing returns. So I'd say that it is complex. Is there a specific answer on how to minimize tax? I'd say that you have to look at the whole picture. But to Jason's point, there is an effective way to kind of recover tax that you would have paid at passive income rates in the corporation by paying it up personally. And the longer you let it go, the more you'll have available to pay out, generally speaking. So, again, a loaded question, I suppose.
Yeah.
So I think you'd have to look at the whole picture.
Scott, you just triggered an executive decision. Check back next year because we're going to have a session on this. There's just some cool variables. Yeah. I'm just thinking as I listen to Andrew's answer, do you co-own this corporation with a spouse? What's your long-term plan as far as like total income you want generated from your broader portfolio? And, what's your marginal tax rate, various things like this. Yeah, we're going to take that one in depth, but hopefully that gave you at least a few smaller things. And of course, if you want to get a hold of Jason and Andrew, you can just Google Objective Financial Partners, or we'll have some details at the end of the show here. We're going to go to Cheryl. Cheryl asks, do you know of any courses or seminars we can take to learn more about high net worth portfolio management during early retirement, where one needs to fund 40 to 50 years of retirement? Many thanks. And I laughed as I clicked this one because I know of a course very well, because I actually just released one called Worry Free Retire, Cheryl.
It was a plant, that question, I tell you.
Yeah, that's right. Yeah, thanks, Cheryl. I don't know you, but I'll send you your commission after the show here. But yeah, in all seriousness, Jason helped me. He proofread a little bit of the course for me. Check out Worry Free Retire. I've got 100% money back guarantee on that. So now that I'm done the self-promotion of it, Jason and Andrew, are you guys aware of any other courses that sort of look at this?
Yeah, I feel like you've taken more investment courses than I have, Andrew.
I know, man. I like. I'm a kind of like academic type when it comes to doing like reading and doing like courses. So I tend to just say like, kind of go with what the experts are doing. So how do you get licensed? Well, most people take the CSC course. It's about $1,000, but it gives you broad exposure to really what you need to know as an investor in Canada, and what experts or people that become licensed or registrants actually need to know.
Yeah.
That would be like kind of one step. I'll be honest, I don't read a lot of personal finance books.
CSC, Canadian Securities course, CSC course, which I've heard of people who've taken that on their own to learn. So that's actually a great answer.
Yeah. But yeah, on the personal finance note, like I'd say I don't read all the books. I don't take a lot of courses outside of what I need to take, but I'd say that is a start if you want like a good round, overall knowledge. But I'm not probably the best person to ask about that stuff. I mean, Jason, you might know some books.
No, look, I think that's actually a great answer. The Canadian Securities course. I took it years ago. It was I think the first sort of course that I took along the path to get my sort of
it covers everything
designation.
Right?
And the Canadian Securities Institute, which offers the Canadian Securities course, has a lot of other courses. I've not looked at them in a long time, but you can get really granular. There's wealth management techniques. There's, if you want to learn to trade options, not that I'd recommend it, but there's a lot of different courses that you can take there to brush up on your knowledge.
All right. Send me an email, Cheryl. We'll figure something out. Okay. And if you've just joined us, guys, and you're wondering how this whole live thing's working, I'm here with Jason and Andrew. We're answering your questions live in real time. Just type them in the YouTube comment or question section, and they'll pop up here on my screen, and then I'll ask the gentleman, and we'll get to them. Friend of the show here, Cornell Schreiber, he had an interesting one that I kind of wonder if this doesn't pertain to him. It's a two-parter here. He says, in your experience, assuming a person's RRSP and TFSA are maxed out, is it typically worthwhile keeping Canadian equities in your taxable account to get the dividend tax credit? The second part is, even though as a consequence of those investments, a larger clawback on government benefits like the Canada Child Benefit, the CPP, or the OAS due to the dividend gross up. So how do you guys balance these things when you look at someone's portfolio and withdrawal strategy, I guess?
It's a great question. I'll comment just briefly on the investment allocation. Like from my perspective, I think if you can invest in a more tax effective way and you can hold your Canadian equities in your taxable account because the dividends are taxed at a lower tax rate, You can hold your US equities and your RSP, because as long as they're traded on US stock exchange, there's no withholding tax on the dividends. Fixed income in your RSP as well can work well. I mean, you can reallocate your portfolio in such a way where you hold more tax efficient things in certain accounts. There might be a little bit of a win to do it. It could end up creating more complexity in terms of the way that you invest your money. And it could end up creating a situation where, I mean, say, for example, you were holding a certain investment in your TFSA that performed really poorly over the next 10 or 15 years and your TFSA didn't grow. You might save a bit of tax, but have a poor, investment outcome. So there's pros and cons. I think it certainly makes it more complex to manage your portfolio based on tax efficiency, but there can be slight benefits. The part of the question about the dividend gross up, interestingly, so the dividend gross up that Cornell is referring to is the way that a Canadian dividend is taxed on your tax return. It gets grossed up. You might have $100 of dividends, but it gets reported as $138 on your tax return, and then you get a credit that reduces the tax. It's kind of a weird system, but that gross up can result in a reduction in your old age security pension, for example. Interestingly, I have found that for most people, most seniors who are subject to an old age security clawback, the clawback is less than the tax savings from earning that Canadian dividend income. So even though you might lose some government benefits, you might end up saving more tax, that it's actually okay to lose some of those benefits. Net, you could come out ahead. So.
Yeah, that makes sense. So like you're saying, if that dividend were taking place in RRSP and then you withdrew it from the RRSP, depending on your marginal tax rate, you might be better off taking the smaller percentage clawback from the OAS. That actually, that makes a lot of sense. It obviously depends on the person's situation, Jason. How about you, Andrew? How have you structured sort of looking at this for folks who in a high net worth situation have maxed out both of those registered accounts and now they're sort of wondering how to structure everything?
Yeah, so what I'll say on old age security clawback, I think that for people that are in a position where Canadian dividends affect their gross income in the sense that they'll get a clawback, I think that if you look at those individuals or those families, they're likely in a situation where it's going to be maybe a losing proposition to try and avoid clawback, because you're going to be in an income bracket that's at a point, or you might have income needs that are at a level where you're going to have to withdraw a certain amount of income from either registered plans or corporations. And if you have that much in a non-registered account where those Canadian dividends are materially affecting your plan, you might not be able to avoid clawback. So you can try and maybe do it. There's some timing that you can maybe try and accomplish. Like, let's say you want to keep, a very large Canadian dividend portfolio, Canadian stock portfolio that pays dividends. Maybe you defer old age pension for a few years. Sure. Again, you have to look at this is kind of similar to the other question, the portfolio side of things as well as the income needs side of things. They kind of interact. And again, I'm saying with old age security clawback, it is very hard to avoid if you're high net worth. I'll be honest, because think about what it is. 130,000 of income is like the ceiling. Once you get past that, around that level, you're basically not getting any of it. And if your income needs are high, and if they're in the hundreds of thousands of dollars, meaning like your lifestyle needs, you're going to have to bring in, over 100,000 of income for a couple. So how do you avoid clawback? I mean, like Jason said, you might lose efficiency by having Canadian dividends in an RSP and having fixed income in a non-registered portfolio. But I guess what's the alternative, right, to having those Canadian dividend paying stocks? Yeah. Are you going to invest in like US stocks that have, punitive tax on the dividends, even though the yield is lower? Are you going to invest in bonds or GICs that pay interest income, which again, that's going to be taxed higher than the Canadian dividend? So I guess the question is also, what's the alternative to doing that?
Yeah, I guess maybe looking at like a swap-based ETF or something, maybe.
Yeah, swap. Yeah, you could do something like that, but that has its own sort of considerations and risks.
Absolutely, trade-offs, and who knows how long that'll even work for. I see Cornell just added a quick. We'll let him chime in with a quick add-on here. Have you looked at it from a Canadian child benefit angle? And obviously that won't be quite as common because we're probably not looking at as many high net worth folks out there who still have children that are collecting that Canadian child benefit. But I do see where he's coming from, because obviously that if you're in sort of that upper tier, collecting that upper tier child benefit, to have that reduced at lower income levels than an OAS would be, that could sting quite a bit. So I'm just wondering if you guys have ever ran those scenarios for anyone.
It's honestly, it's a social benefit, and it's for people that need it. So I guess that might be an unpopular answer, but if you get clawed back on it, you get clawed back on it. I sold a rental property a few years ago, and that basically made my child benefit go to like almost nothing. But I had to eat it because I made money on that investment. So I think, again, it's unpopular for me to say that, but I say that in some cases, there might be a way to skirt it over a couple years or period of time. But ultimately, these are designed for that purpose, is to not provide these benefits to people that don't necessarily need them.
Right.
Yeah. I haven't encountered a lot of situations where people are losing Canada Child benefit because they've got significant Canadian dividend income. Like, the scenarios that come to mind would be somebody who's, financial independence, retire early, someone who's retired with a big non-registered portfolio. Don't see a lot of people with young kids who would qualify for the benefit that have a ton of non-registered investment income. Could happen for sure, but I don't know. I've never looked at it.
Yeah, that's I think exactly where Cornell's coming from, is sort of that fire background, and I know he and I have kind of thrown thoughts around on that before. So I think the same principles are in play regardless of whether we're talking OAS or Canadian Child Tax Benefit. And Andrew, I think it's part of a bigger debate, but I think that's absolutely a relevant take, is that's not a bad problem to have if you're making so much money as a retiree or someone with children.
I don't know.
That's a pretty good problem to have. But all right, SP asks, is it more beneficial to take money out of an RESP and put it in a TFSA, or just let it grow in the RESP? And I'm not sure, SP, if you mean if you're still in the accumulation stage here, before your child or children have actually begun post-secondary study and are taking the money out, or if they've got the option, if they're adults but maybe not in post-secondary study. I'm not totally sure on all the background to that, but what do you guys think in general of some of the considerations here?
So I guess with an RESP withdrawal, you need to, in order to not be repaying government grants that you've received in the past, your child generally needs to be in eligible post-secondary education. If you're in a situation where you're drawing money out of your RESP because your child's at college or university or trade school or wherever the case may be, it certainly is not common that you would turn around and put it in a TFSA. Usually you would actually legitimately use it for post-secondary education. There's no reason that you couldn't or the child couldn't turn around and contribute it to their TFSA. So I'd say I wouldn't consider this to be a specific strategy. And RESP is a great way to save for post-secondary education. If you're going to withdraw money, child started university, if they don't need the money, say they've got a scholarship or they're working or whatever, if they have extra cash flow, like just period, then by all means, once they're 18, they get TFSA room of their own that they could contribute. They've also got now FHSA, First Home Savings Account contribution room that they could contribute. So I think anytime a child has extra cash, whether it's coming from the RESP or otherwise, by all means, taxable investments themselves, they could actually just take money, give it to contribute to a TFSA or an FHSA. Issues with that. So wherever you can get tax sheltered accounts, for sure, go for it.
Yeah, Andrew, as we were kind of replying here, SP gave us a few more details. They said their child has started university and is nearing graduation. So anything to build on there?
Well, I mean, the thing I think of is like the tax deferral in both accounts. So if you had the option, if you were going to take the money out and you didn't need it for expenses, you could put it into a TFSA if you have room. The money in the TFSA will grow tax-free, no income. The RESP, though, a portion would be EAP, which is like capital return. And another portion would be EAP, which is taxable to the beneficiary. So I think that you have to think about what the deferral is worth. In one case, you have a hybrid. In the other case, you have no tax. Mm-hmm. So if there's an opportunity to get the money out while the kid's still in school, while the child's still in school, maybe no income, then you want to make sure you extract all of that before they graduate. And then you could immediately just like kind of take it out and put in the TFSA if there's room. So I think that the tax deferral, I guess, is similar, not exactly the same, but you're going to get a lot of tax. You're going to get obviously more efficient deferral in the TFSA because there's no tax. But with the RESP, you kind of have to take the money out, right? Unless you have like a family plan or something like that, you don't want to really leave it there. If you have the opportunity to take it out, make sure you get all that grant. You don't have to claw any of it back. So while you're eligible to take money out of this account, do it. Because otherwise, like you kind of had, once school's done, it's done, right?
Yeah. The only other thought,
want to keep that hanging around.
The only other thought I had was definitely, like you say, take out that taxable portion of it, Andrew, in the hands of the student, presumably having a fairly low marginal tax rate at that point. And if you haven't maxed out the RRSP yet, your personal RRSP, just to realize that you can roll that back.
There's that too, right?
But assuming, if we're part of a high net worth conversation here, you might have a maxed out RRSP.
But honestly, like the FHSA is a good tie in here, what Jason mentioned. Like that account.
Yeah.
If you can get that funded now for your like 18-year-olds, wow. Like think about it. Because you don't even have to deduct it against income. You can keep that RSP deduction.
Yeah, right.
You can carry it to a point where you're making a good income and then use it at that point in time. So honestly, if you have the flexibility to be able to put money into those accounts and to allow it to compound maybe for, who knows, maybe 10 years, like those are going to be pretty sizable amounts of money, I think, for down payments in the future if people use the accounts properly, meaning get it funded as soon as you can and then carry it through like the 5 years.
Mm-hmm. Yeah, definitely. If you have the luxury to be able to do that for your young adult child, like you say, possibly a massive advantage building there.
Yeah.
We got a curveball here from France coming maybe from a part of Canada that's near and dear to me as a farmer. Would you have any advice on how to optimize taxes for a corporation that owns agricultural land and operates a small farm among other activities? I know that farm business planning is like almost totally its own ball of wax, but have you guys ever ran some scenarios for anyone like this?
Yeah, well, look, I mean, there's a really amazing tax incentive for small business owners and farm owners generally. So there is a lifetime capital gains exemption that's currently $971,000 or something for the sale of an eligible small business or a farm or a farm corporation. So I think you want to make sure that you are doing everything you can so that the corporation eventually, upon sale, qualifies for the lifetime capital gains exemption. There's a lot of different rules that apply depending on when the property was purchased and to what degree it is farmed. So it is sort of a complex area. But I mean, that's big dollars. If you can have a $971,000 or up to a $971,000 tax-free capital gain, you're saving $250,000 plus in taxes, depending where you live in Canada. Beyond that, I think it's a lot of the same tax planning that you would do generally as a business owner. You know, if you're building up cash and investments in the corporation, you know, how should you be drawing income out of that? Should you be paying salaries? Should you be paying dividends? You know, what happens if you're earning investment income and you're paying that refundable corporate tax? You know, should you be taking out personal dividends to get corporate tax refunds? So the farm lifetime capital gains exemption certainly is the big one, but a lot of similar small business planning that would apply.
I know that several friends growing up around a lot of farm kids and then getting to know them all as they became adults and started to inherit the farm. The one piece of advice I would say is look into whatever farm transition and exit plan sooner rather than later to give yourself as many options as possible. I don't know all those options, but I do know that gradual equity shifts and salary and dividends and various things, as well as making use of the tax situation Jason just described, that will help. Andrew can probably be a little more specific.
Yeah. So on this farm transition, I think to me, like, I mean, in a previous role, not with Objective, I did work for an accounting firm that did a lot of this kind of work. And what I would say is for farm owners that think that, you know, there's a potential that they're going to sell the business and that it is a working farm, I don't think there's any issue in trying to at least get a little bit of like advice on what are the qualifications, what do you need to have in place to qualify to be able to use this lifetime capital gains exemption, and at least have a range to know whether or not it's going to be part of your plan or not. Because I mean, I've seen people that have farms that don't qualify because maybe it's just not being used in a specific way. But just having that information might help understand what the trajectory of the farm will be over the next 3, 5, 10-year period, so that you know that when it's ready and when you're ready to sell it, you kind of have an idea of whether or not you're going to get some tax benefit or not. So it requires a little bit of pre-planning, like you said, kind of knowing where you stand, what the farm's doing, does it qualify for these benefits? But then on top of that, also making sure that the entire sort of remuneration strategy between personal and corporate is effective as well. And yeah, part of that planning might be extracting money out of the business over time, or passive money out of the business over time, so that if you want to sell the farm, it's clean and it's available for the lifetime capital gains exemption.
All right, France, if you want more information on that, get in touch with Andrew. If you Google Objective Financial Partners, we'll hook you up with Andrew. We'll get you there. If you just email me, I'll make sure he gets it and we can work on some more details. Because like I said, I know that farm planning has some interesting nooks and crannies. All right, I think we got time for one or two more here. Scott says, how do you use the credit in your capital dividend account? This is an interesting question that would pertain mostly to people who've sold their business, I believe. Is that correct, Jason?
Sold assets within their corporation. So
right.
Capital dividend account, when a corporation has a capital gain, you can end up with a capital dividend account. So if you've got an investment holding company, let's say, and it sells a stock or an ETF or a rental property or some other asset for a profit, that profit is considered a capital gain. There's tax to pay on it. 50% of the capital gain is credited to this notional capital dividend account. So it's kind of like a fake account that CRA tracks. And if you have a capital dividend account balance, you can pay out a capital dividend to the shareholders of that corporation. And a capital dividend is tax-free. It represents the tax-free half of a capital gain. So if you have a small capital dividend account of $500 or $1,000, it might not be worth accounting and legal fees that are involved with paying out a capital dividend. But if you've got a significant capital dividend account, it can definitely be advantageous to consider taking that amount out. And one little nuance, getting a little technical here, but if you have a large capital dividend account balance, it's often advantageous to declare a capital dividend, even if you don't pay it out. And if you don't pay it out, it then becomes a due to shareholder that is owed to the shareholder tax-free in the future. The reason for doing it is if you have capital losses on investments in a future year, that can actually reduce your capital dividend account. So it can often be advantageous with a big CDA account, capital dividend account, to declare the dividend, whether you take it or not, to kind of lock it in and turn it into a tax-free owing or due to shareholder.
Are those the most common applications that you've seen as well there, Andrew?
Yeah, like Jason's point makes sense. Like if you don't need the capital, you don't need the money personally, you can trigger the capital dividend and just create a loan, shareholder loan, that can be repaid in the future. Sometimes people use life insurance and use the capital dividend concept there. So they'll like buy a corporate life insurance. Often the way it works is, if there's a payout, the company will receive the insurance, the death benefit, in many cases tax-free, a large portion of it at least. And that could be used to pay like corporate tax for the estate, could be used to pay out money from the corporation out. So there's various uses of it. I'd say that what I've heard in the past, that there's like an election cost to doing so. I've heard different views on this. Often it's quoted that it's in the thousands of dollars to like make a CDA election, but I've also heard of people doing it for less. So I'm not sure exactly, but my understanding is that generally you won't do it on a yearly basis because of that cost. But that some cases you might pool enough deferred gains, crystallize them, pay out the dividend maybe on a regular basis, not just necessarily every year. So yeah, it can be used in different ways. Some people use it, for example, to fund large one-time purchases with their corporate assets. So let's say, they want to buy a cottage and they have, a large portfolio, or maybe they sold a building or whatnot in their corporation. Now they have a massive CDA, they pay tax on it in the corporation. Now they want to get some of that money out to pay for that. It could be a bit of like an emergency buffer where they have sort of a base layer of income and they don't want that extra income for that purchase to affect their overall personal income. So they'll do a CDA election rather than maybe like withdraw everything from their TFSA or borrow money. So it's an effective way to kind of provide income where maybe you've already paid tax on it and you don't want it to affect other parts of your plan. So there's different ways to use it.
Yeah, that would be a great option for needing to access some capital quickly in a tax-friendly way, providing that you have the capital dividend credit like Scott does.
Yeah.
All right. Vadik asks, any strategies for high-income T4 employees? I guess we've been helping out farmers and corporate folks here. It's time for just your sort of a little more vanilla high-income T4 employees. He doesn't want to move out of Canada, wants to stay in Canada. He cites things like spousal loans, borrowing to invest. Is there anything else he's missing? So maybe some common strategies that you guys have seen for high-income T4 employees over the years.
Yeah, spousal loans, maybe just to speak to that. So a spousal loan is when you loan money to your spouse, obviously, but there's a reason for doing it. You can't just give money to your spouse to invest. If you do and they invest it, the income gets attributed back to you due to the spousal attribution rules. You can loan money to your spouse at the CRA prescribed interest rate, and they then need to pay you interest that you report as income on your tax return. They can deduct the interest. You claim the interest as income. Part of the problem is that CRA prescribed rate has shot up, obviously, with interest rate increases generally. For a number of years there, the prescribed rate was at 1%. So it was advantageous to loan money to your spouse at 1%, because if they could invest it at anything higher than 1%, there'd be a net benefit, a net shifting of income over to the other spouse. So spousal loan currently not really a worthwhile strategy in Canada. Maybe in the future, beyond maxing out RSPs, TFSAs. I mean, borrowing to invest, I don't know if I necessarily view that as a high income strategy per se. We have a lot of high income T4 employees, a lot of high income clients generally, and I would say very few of them borrow to invest. You might be able to borrow and invest the money at a higher rate of return, but I find a lot of times, if you borrow $100,000 at, these days it's 7%, and you invest it at 8%. You've got a 1% benefit on $100,000. It's $1,000 pre-tax. It's $500. It doesn't. You'd need millions and millions. Even then, the percentage would be so small. So, to make a 0.5% profit after tax, I find it's not that advantageous. I think it's just more, general best practices, trying to split income legitimately between family members. Having the lower income spouse do the investing in their non-registered account, and the higher income spouse pays the bills, looking for opportunities to contribute to your kids, TFSA, FHSA, etc. Trying to invest in a tax efficient manner. Some people look at options like life insurance. I find that, pros and cons to doing that. I'm not generally a big fan unless, like Andrew mentioned, you've got a situation where you've got corporate assets and more money than you're ever going to spend in your life. It's a great way to get money out of a corporation into the hands of your beneficiaries. But for a high income taxable investor to go buy a life insurance policy to save tax, you end up often paying more in fees than you save in tax. So,
yeah.
Any other low hanging fruit, Andrew,
Yeah.
or more exotic strategies?
So I would say maybe not necessarily exotic strategies, but I guess you have to think about what kind of tax we're trying to save here. Are we trying to lower the actual T4 income, or are we trying to make the investment income efficient? Because I think those are two different things. In order to get that T4 income lower, there's virtually nothing you can do other than an RSP deduction. That's really the big thing that people do. And a lot of people, that's already satisfied through their group plan or a pension they might have. It's what you do after that with that sort of post-tax income. So, the spousal RSP, again, could relate to the other RSP. That's one option. There's the TFSAs trying to max it out for yourself and your spouse. Then we're talking about kids. Maybe they're adults do their TFSAs. So that's ways to like really avoid tax to you personally by kind of putting into other places that are not attributable to you, right? But like, yeah, outside of that, you could look at specifically like, okay, if you have excess money that you can't put into any of these accounts or to split, do you have debt? What are you paying on that debt? Maybe it makes sense to repay debt rather than invest that money and earn income on it. So there's kind of like, so for example, like I have clients that, maybe they're in the highest tax bracket, but they have $1 million mortgage and they're saying, hey, what do I do with all this extra money? I'm like, well, what's your rate on your mortgage? Is it 7 or 8% or 7% right now? They're like, yeah. I'm like, well, what's your expected return in the market? Think about your tax situation. You invest that money in the market or even in one of these like really nice 5% GICs. If you invest that money, you're going to be paying tax at the highest marginal tax rate. So you have to kind of look at the overall picture in terms of what are your income needs, what are your opportunities to split income, and then do you have opportunities to use that money, maybe not to invest, but in other ways, for example, debt repayment. So
great. Oh, sorry. Just to finish up, Jason, go ahead.
Yeah, no, I see the latter half of Vadic's question there. So maybe just to speak to that, the thought to borrow to invest is deduct to the top tax rate. I mean, you're deducting the interest. If you borrow money to invest, you're deducting the interest at the top tax rate, but you're also earning the income at the top tax rate too, right? So you get tax deductions when you borrow money to invest. You borrow $100,000 and you pay 7% interest, let's say, you get a $7,000 tax deduction. That's great. But you would need to invest it at a fairly high rate of return. Say you invested it at a 10% rate of return. You're only going to keep half or maybe a little bit more than half of that after tax, depending on how you invest it. So you're getting the deductions at a high tax rate. You're paying a high tax rate on the income. And again, at 7% or 7, I mean, these days a line of credit 7.2, 7.7, even if you convert it into a mortgage, you're paying 6.5 or 7%. I would like to hope that a low-cost stock portfolio will return more than that over the long run. But again, how much more? Do you earn a 1% profit on the $100,000 or whatever, and then again after tax, are you $500 ahead for going through all of that, taking on the risk? So again, pros and cons. I'm not a big fan of it, especially for a high net worth investor. I find if you've accumulated a lot of wealth and assets in the first place, that incremental 0.5% may not matter much. Most of the people I've seen borrow to invest have been the wrong people. Unfortunately, it's been people that have been pitched by their investment advisor. Their RSP is not maxed out. Their TFSA is not maxed out. So proceed with caution. You need to have a high risk tolerance and low investment fees, in my mind, to make it work. And would I do it in this sort of an interest rate environment? Probably not.
Yeah, and Kyle, you mentioned those swap-based ETFs. That's another thing that people do, or they'll buy like capital investments that don't have dividends or income potential. Like, we always hear about these in financial media, right? Like the Berkshires of the world and like the sort of like the Horizon swap-based ETFs. Like these are specific ones that like have come up in media, but like people will invest in things like that because there's not like an ongoing income stream that's going to be taxed at like 53%. So then they can at least defer the income on the cap to kind of convert it to capital gain down the road when maybe they're in a lower tax bracket. So that could be like one way to look at things too. But again, the risk is the important key there. It's not the tax. It's what's the risk that you're taking to buy that investment, and is it going to be incrementally higher than the alternative that you may have invested not from a tax perspective?
If you want to work through more sort of scenarios and trade-offs like that with Andrew and Jason, you're going to head to Objective Financial Partners. Jason's going to be back joining us on Saturday, so pay attention to your email invite for that. Andrew, why don't you tell us a little bit more about what we can expect if someone contacts Objective through the website and says, I want to work with Andrew. What's that going to look like, and what do you do there at Objective?
Yeah, so our process is pretty simple. You reach out to us through our website. We start with a 30-minute consultation for every person, so it's a free intro. It's to go over your whatever unique considerations you have to bring to the table that you want to ask us about. We are capable of discussing most financial topics. We can talk, cash flow. We could talk budgeting, debt management, investment management. We could talk about all these topics. The two key points that I'd say for us versus like the traditional world is that there's a couple of things we can't do. So we can't give specific advice on investment. So I just point that out first. So though we're talking about investments openly here, I cannot recommend that you buy or sell anything. What I can do is talk about sort of product features, fees, structures, so that you kind of understand what you have. But by no means can I tell you what to buy or sell. So that's number one. Number two is we don't sell anything. So if you're looking for a consultation or a planner that is not going to be pitching anything to you, you will not get pitched anything. However, if you're looking for help with finding options or products, we can help facilitate that. And we don't accept referral fees for any of that right now. So what I'd say is that if you want a sort of a very open and objective discussion about your financial life, and you don't want to worry about getting pitched anything, and you want sort of robust advice from someone or form of individuals, all of us are quite experienced that have been in the industry for all of us over a decade, then we're a good spot. And we'll be very open and reasonable and fair and really discuss in a transparent way what it costs to work with us. And even our website kind of points to that. So you can look there, you can kind of get a range for what we cost. So I'd say, yeah, if you're looking for someone to look at your situation and look at it from an objective standpoint, we're a good option.
Transparent advice from a decade plus experience and benefiting from a whole team worth of specialties there at Objective. And most of all, no sales, which is still a pretty rare find on the Canadian scene. So head on over to Objective Financial Partners if that interests you. Thank you very much to Jason and Andrew today, and thank you to everyone for chiming in. And if you want to tell some of your friends and family who bought the All Access Pass or have yet to buy, this will be recorded and will be behind that membership wall. So thanks again, everyone, and we'll see you on Saturday.
Thanks, Kyle.